Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti financial advisor. Thank you for attending this show today because this show is for you. You that work so hard for your money and you're now ready for your money to start working harder for you right now. You want that freedom and cash flow today, not 30 or 40 years from now, but you want it right now so you can live that life that you love with those that you love. But I know it's not just about getting rich because you want to live a rich life. Because as a rippler, you want to create a ripple effect in the lives of others. Because as you're blessed financially, you have a greater capacity to bless the lives of those around you. That is exactly why I'm here today and not just retired. Thank you for tuning in. Thank you for binging on these episodes and being a part of this show right now. Okay, one thing I want to be able to make clear is that we have now moved our podcast to our main Money Ripples channel. So if you haven't subscribed to the Money Ripples channel, please do so. Yes, we still have the Money Ripples podcast channel, but now that's become more of a shorts channel. So if you love shorts and little tidbits of information, definitely subscribe there. But be sure to be on this Money Ripples main channel to get these podcasts live right now.
Chris Miles was able to retire twice by the time he was 39 years old. But he's not content to just enjoy his own financial freedom and peace of mind. Chris wants you to have your own ripple effect so you can live free today. He's not the financial advisor you expected. He's the anti-financial advisor you deserve. He's jumping behind the mic right now, ready to make waves. Here's Chris Miles.
So I want to take a different spin. We've talked about infinite banking on this show before, but I want to talk about life insurance as an asset. Yeah, and I don't just mean after you die, right? I mean an asset while you're alive. We've talked about the fact you can double dip. You can get your investment money to pay you twice when you use this kind of tool. You can also use it as a tax-free supercharged savings account. This is something that's like a Roth IRA, but it doesn't have all the dumb limits, doesn't have all the income limitations, and you can use it as a way to be able to store your money, make better returns than point nothing percent in the bank. And funny enough, that's my topic today because guess what? Although the banks pay you diddly, guess what the banks put literally billions of dollars of their own assets and their own cash into? You got it, life insurance. And I don't mean term insurance, right? They're not just buying that. They're actually buying something with real liquid cash that's available. That's that cash value, that tax-free savings account inside of life insurance, specifically permanent life insurance, like whole life insurance. That is what they buy. Now, yes, some of them will buy universal life and things like that, but I want you to literally figure out why the banks are using this so you know why you should be using this too. Now, one thing you may not know, and yeah, I'm going to put a link to a video from one of my friends, Hutch. He did a video on this, but you can go to FDIC.gov. You can look up all these banks' assets, and when you look this up, you can actually see where the banks are holding their money. Now, I didn't realize life insurance was a part of this until I read the book Pirates of Manhattan, a great book by Barry Dyke. I definitely recommend anybody who wants to read and get more into this why banks have been buying life insurance for literally decades. And if you actually watched one of my previous episodes just a few months back with Eddie Wilson, Eddie's a very successful entrepreneur. His grandfather was a bank owner and bank president. He said the same thing. He taught Eddie about why it was so important to have life insurance as an asset. And the banks have been doing this for many, many years. And what you'll see is, especially as we move into a closer to recessionary times or times when the markets make sense, they actually put more of their assets inside of life insurance. I remember actually during the last Great Recession, there were banks like Wells Fargo putting 22% of their assets into life insurance. Now, why would they do this? Why would they want to put their money in something that could be a waste of money? And I'm not even saying that they do it the best way possible because when we set up our policies for you guys, and yes, we do it internally here as a team, the thing is when we do it with the max ROI possible. And they don't always do it this way. Most of the time, the banks are doing this for a few key reasons. One, they're buying key person life insurance on their executives, on those that are in their company, presidents, vice presidents, C-level executives, and people like that. They're putting these policies on really their middle managers on up, right? So they're buying these assets, but they're not just buying it because they want to have as a protection for their employees. They're doing this because they know it's an asset they can hold and use it as a store of money. And because of the same things we talk about here about getting that arbitrage, meaning you can take that money and be able to get a higher return off of that money than what you borrow it for when you try to borrow it from the insurance company. The great thing is you can get a better return. So banks actually do this because, believe it or not, banks have what's called fractional reserve banking. which means that if you've ever heard banks loan out more than what they have in deposits, in savings and CDs from you guys, the reason they can do that is because they're legally allowed to loan up to, or not, they're legally allowed to loan out at least 6 to 10 times the amount of cash that they have in their assets. Now, different assets that they store allows them to leverage it more. For example, if they had just plain old cash sitting there, money market type of funds, they can leverage pretty much 10 times that money. So if you put $10,000 into your bank account, into their bank account more specifically, you put 10,000 in there, they have the ability to loan out $100,000 to somebody. Now, I want you to do the math on this. If you put in $10,000 and let's just say you get paid a whopping 1%, you make a really just a whopping 100 bucks in a year. But if they can take that 10,000 and they're able to loan out $100,000 and they make 7% on that $100,000, they've now made $7,000 while the cost to them, the investment was only 100 bucks of interest paid to you. So that the investment is 100 bucks to then make 7,000 bucks. That's a no-brainer, isn't it? Well, life insurance is one of those they can leverage up to almost that full max. Now, if they try to have money in stocks, they couldn't leverage this money as much. They couldn't do anything with it very, very easily. But because you have the money sitting inside their life insurance, and they have this life insurance cash growing and building, and it's guaranteed to grow and build, they're allowed to leverage and pay for more money. They're able to loan out more money to you. And that's how they make a lot more money. And then during recessionary times, they know this is a safe haven to go to. This is the kind of times we're leading into right now. So there are banks out there like your Wells Fargo's and your Bank of America and all these kind of companies that have a lot of assets. So one bank in particular, I won't mention names, but again, you could look these things up yourself. But one bank in particular had about $10 billion in real estate owned between their branches as well as just real estate in general, whether it's from things that they repossessed or whatever it might be. They had roughly about 10 billion in real estate. But in life insurance, their total assets are actually about $21.2 billion. So more than double. And this is something you see very common is that, yes, real estate is great. And I love real estate. You know this. But they also have a lot of cash sitting in life insurance reserves. Again, because that money is not just something that they can use as an incentive, although it is a good incentive for their employees, but they use it because it's liquid. They can access that money whenever they need to. And that's especially true. And you need that during recessionary times, just in case, not just for emergencies, just in case something goes wrong, but also if things become frothy, if things become because if you have something where there's a great opportunity to buy something, you want to make sure you have the cash to buy it when it's there. So there's a great opportunity in that sense. So it's a great devastation type fund, emergency fund, and it's a great opportunity fund all wrapped into one. But it also has all those tax benefits where it's tax deferred, it can grow and come out tax free, all those kind of things. You get those benefits with it as well. I mean, there's just so many things. I even mentioned before, like it's like a Roth IRA. It's got, it grows with tax free, comes out tax free. But the great thing is that there's no income limitation saying, well, you make too much money. Sorry, you can't contribute. You have to do this backdoor route to get there, or this 59 and a half rule, you get penalized. Nothing like that. They don't have those kind of things going on. Again, this is why banks have loved using life insurance for many, many decades and been used as a big part of their portfolio. Now, I'm not saying you put every dollar into this because banks don't either. That's not what's important. The important thing is that you're leveraging this as a tool for one to stay liquid. And right now, it's more important than ever to be liquid because Warren Buffett, he's just increased his assets by $27 billion in just cash in just 6 months. I mean, that's a lot of cash he's trying to build up quickly because he knows there's a big storm coming and it's not a good one. It's not a good one, at least if you're not prepared. Great if you are prepared, because imagine if it was 2012, you could go back to 2012 and start buying up real estate. That would have been the beautiful time. 2011, 2012 would have been a great time to get more and more into real estate. If you had all that extra cash to buy it, that would be a great opportunity. There are some big economic wins coming. I just did a video recently that came on this channel. We talked about this, where the interest rates, they're still planning to raise them. And they don't even want to lower them very quickly either. They actually think the rates will stay elevated for a couple years. I know there's tons of real estate investors that are banking. In fact, they're wishing and praying that interest rates will come down, because if they don't, that financing that they got short term is going to turn into long term financing, and they're going to go broke. There are going to be a lot of opportunities in the multifamily, the apartment space. There's going to be a lot of opportunities there. But even just on a personal level for you, is that when you have cash, you can control the terms. That person that has the cash can become a king or a queen in times like these. You want to make sure that you are liquid. You want to be prepared. So again, it's not that you don't invest, and it's not that you put every dime into these things, but this should be something that's a part of your portfolio in as much as you have decent health, at least and you're under the age of 70 and you're not paycheck to paycheck. If you've got some cash that you're trying to put away, build up for savings, this could be a great opportunity for you, just like the banks have been doing for many years. They just don't advertise it. They don't care to. Why? They don't have to, right? But they have to disclose it, which is why the FDIC.gov has a lot of these assets there. So I recommend from this, I'm just going to keep this short and sweet, but I want you to really ask yourself is why would banks put so much money in here? Is it because they're stupid? No. There's a reason why banks have survived for a very long time. It doesn't mean the banks haven't gone out of business, but the bigger banks, the ones that know what they're doing, this is what they do to lessen the risk of their overall money. They want their money to work for them, and they want to have better leverage, better use of that cash, and not just let it sit there and make nothing. Right? That's why they don't just put it with other banks necessarily, making almost nothing in interest if they're trying to loan money to different banks, which they'll do, but they keep money here because they make bigger returns and it's not taxed while it grows. That is the key thing that they want. They want better tax benefits, so it's not taxed by the IRS. They don't want all these limits and limitations put on them. They want to be able to put in more if they want, and they want to make sure that they have the ability to access it when they need it. That is important for you. If you want to win with this coming recession, you need to have cash accessible when you need it. If you don't, you're going to be like everybody else saying, "Oh, I missed another opportunity." Well, hopefully everybody will go broke or get unemployed again, and then I'll have an opportunity again someday, in another decade or whatever it might be. This is your opportunity right now to prepare and be ready. So I recommend getting the book Pirates of Manhattan by Barry Dyke. And I also recommend too, guys, if there's something that you want help with, if you want to see how you can set this up for your situation or see what it would look like, reach out to us at moneyripples.com. Go and make it a wonderful and prosperous week. We'll see you later.